the forecast yesterday on the fan chart had us moving out towards the 2% on inflation by 2022, I believe it was. But we would see something like 1.75% for 2021. Given, as you point out here, that half of the British gilt market is in negative territory at this point, are we sort of marching forwards to some kind of crisis in the market? Are we living on borrowed time here? Because that seems to me that a lot of people that own gilts are the wrong side of the story if inflation is going to be heading up to 2% over the next 24, 48 months.
No, I think and you're seeing this, we're in a position where the gilt market, as I've emphasised, March, there were very, very challenging conditions. We made a very significant intervention on the 19th of March, a kind of out of the decision, which was designed explicitly to restore market function with our purchasing of 200 billion of gilts and corporate bonds. And you've seen conditions improve really markedly. Bid-offer spreads have come back much more to where they were pre-COVID. The market is functioning well. So, but equally, as the projections we put out yesterday show, we are forecasting that the recovery continues. We think the pace of the recovery will slow, but the recovery will continue. And once we're through the short-term factors that are alongside the weakness of demand pressing down on inflation, we think, as our forecast, the central case showed, that inflation will rise back towards target towards the end of the forecast period. So, we see a return to something which is closer to the pre-COVID levels of activity and inflation, but it's going to take time to get there.
Obviously, the governor was reticent to be too committed on what action is taken next on the asset purchase programme, and I guess you're probably going to go with him on that. But as you will have seen, the market is pricing in an announcement in November of another 100 billion sterling in asset purchasing. Is there a theoretical ceiling or an implicit ceiling on just how high the bank can go in terms of expanding the balance sheet at this point? I wonder if you can just talk a little bit about whether the market is correct to continue pricing in these additional amounts.
Well, one thing that we have certainly learned through this crisis so far, and you saw that in the new analysis that we put out yesterday in terms of our considerations around negative rates, is the position is evolving all the time. So before the crisis, previous Governor Mark Carney and current Governor Andrew Bailey both gave a sense of what the potential headroom was for policy based on assumptions at the time. Obviously, we revisit in real time assumptions, and since that time, since the crisis hit, we've done an additional 300 billion of asset purchase. The current 100 billion programme is still progressing at a pace that announced is slowing to around 4.5 billion to enable to complete that programme by the end of the year, considering the MP's wishes. I am going to repeat what Andrew said yesterday. I'm not going to get into speculation about where we might be in November, but we do have further headroom and use. That's clear. There are different ways of calculating that, but we do have headroom. But our decision as of yesterday against this set of projections was that we didn't need to introduce any more, but what we did introduce was forward guidance to make clear that we won't be considering tightening policy until we see clear evidence that spare capacity that has opened up with the weakness of the economy is closing, and that inflation is rising sustainably back to target, as you were discussing earlier. But no, I'm going to give an indication of where policy might be in December.
Deputy Governor, you included a section in the Monetary Policy Report which assesses negative rates and the suitability of negative rates for the UK as a policy instrument. And Andrew Bailey yesterday making clear that that's a policy tool that remains in the toolbox for now. But can you give us some more insight into how you're thinking about conditionality and what are going to be the key determinants that will lead to your implementation of this policy potentially in the future?
And thanks for picking up on that work that we published yesterday. And I think it is important to highlight that that's the first time that the MPC has published anything collectively about negative rates in that box. And that box does really set out the key conditionality. And I think it's, there are two elements to it. I mean, one, we have benefited from looking at the experience of a lot of other countries, some of whom have experimented or moved towards, after a period of move towards using negative rates. Some other jurisdictions haven't. And I think the two key bits of conditionality, one are to take account of prevailing financial structure, because that will determine the transmission, whatever the interest rate path is, to the economy. So how rates get through to rates on deposits, particular lending rates. And the second piece of conditionality is where different economies and jurisdictions have been in terms of the state of the system. And our box runs through those two elements of conditionality as being key. There are other factors that we have to take account of, how you'd actually operationalise it. But for me, those are the two key elements of conditionality. And I guess the key point to stress, because I'm not going to say, if this applies by some date in the future, then if X applies, we'll do Y. But what I think is really important to set out, what Andrew highlighted yesterday, and what we're really keen to stress, is that negative rates now are in the toolbox alongside quantitative easing. We're engaged in that programme alongside the new forward guidance that we announced yesterday. They are part of the toolbox, but they're in the toolbox at present. We're not actively planning for negative rates. Or indeed using them. We're using tried and tested policies, such as quantitative easing, and we're currently engaged in our latest programme of that.